Okay, guys, I want to go ahead and get us started back. I don't know, when you guys asked me to record it earlier, did it show you that little message saying, do you want to continue?
No, Professor, not to me.
Yeah, so I thought I hit record, but I guess not. But what I'll have to do is I'll make the recording from last summer available to you because it's the same material, and you'll have to watch that. It won't be your exact class. And then you can watch that up to what, page 47 here. And then you'll be able to see the recording going forward. When somebody told me to record it, I thought I hit record, but I guess I hit the wrong thing and it didn't record. So anyway, it is recording now, and you'll have to watch last time. So you'll see that over here. It's hidden from you now, but you'll see it. I'll unhide that, and then you can find the not-for-profit stuff. I think in there, and then once you hit this page that we're starting on now, then you can switch over to this lecture. Sorry about that. I thought I recorded it, but apparently not. Okay, so where are we now? I want to go back to module 4 here, and let's go ahead and take a look now at the statement of cash flows. Okay, so we've dealt with the balance sheet, statement of net position. We've dealt with the statement of activities, which is like the income statement. And when we deal with the statement of cash flows, they tell us that basically we will use the FASB codification section 9230. But remember, it's 958230. We'll talk to you about things that are specific for the not-for-profits version of the statement of cash flows. Now, what we're trying to say to you here by making that point, Becker, is that, look, statement of cash flows is very similar to what we talked about last time in this chapter. We have operating activities, we have financing activities, we have investing activities, okay? So what happens when we have proceeds that come in, and the proceeds are essentially unrestricted, contributions come in unrestricted, those go into cash contribution, obviously. Those go into the operating activity section, okay? Now you come over and they talk about some other things, okay? And unrestricted resources, okay? I'm sorry, guys. There's one other thing I was looking for here. Okay, proceeds from the sale of financial assets, again, not restricted, okay? So these things are considered operating activities, and basically you're looking for things that are not restricted. Now, you come down, and when we talk about the investing activity, okay, investments in property, plant, and equipment, okay, are going to be obvious investments. Now, financing activities, and notice receipts from contributions restricted for the purpose of acquiring long-lived assets. And sometimes students find that a little bit confusing because they say, well, you say when I make the investment, it's investing, but when the money comes in, it's financing. That's right. When you get the money and it's restricted for a particular purpose to buy something long-term, then you're going to go ahead and you're going to put that in the financing when the money comes in, and then when you spend the money, it is going to be investing. Okay. Also, notice receipts from contributions restricted for purpose for dealing with donor restricted endowment funds. Okay. So if they sit here and they say, well, look, we're giving you some money and here's the earnings off of that, dividends off of that and whatnot, then that money is going to be restricted. Those dividends and whatnot that you receive would be reported in the financing activity column. Okay. So when we look at the example of the statement of cash flows, okay, just come over to that statement of cash flows example. We start with cash flow change in net assets. So this is like the indirect method. And notice here, some of the things are pretty straightforward that we said, unrestricted contributions and whatnot. But notice here, and I'm trying to highlight this 300, because this gets a little bit weird, where we take out an amount, interest and dividends restricted for reinvestment, and then we turn around and we do what? We plop that 300 in here. Now, the reason we do this is we are sitting there and basically reporting a net income number. And net income includes what? Includes non-operating items like our increase in our investments. So what do we have to do? We have to back it out of the operating section because it would have to be reconciled to come up to cash provided by operations and net income. And we move it down where they've told us that we should put contributions that are restricted, which is down in the financing section. Okay, so just a little bit of a weird approach that they take there, and that's what's going on there. But very, very similar to what we talked about statement of cash flows for for-profit entities. Okay, all right, good. So let's go ahead and let's take a look at this question. Okay, guys, 10 seconds. All right, let's take a look at how we did. Okay, not too bad. You know, C is the correct answer. Most of us got it correct. Okay, but let's just go ahead and let's take a look at this one. Okay, and Let's see. We have the Jackson Foundation, a not-for-profit organization, received contributions. Jackson's statement of cash flow in year one should include which of the following amounts? Cash contribution without donor restriction. We said that that's going to go where? Operating. Cash contribution of 200,000 with donor restriction, which specific requirements relative to the acquisition of property. We said that what? When you get the contribution, that is financing. And then when you spend the money, that is what? That is investing. So since they're just receiving the money there, the answer would have to be choice C. Okay. I mean, I think you could pretty much eliminate choice A here. And so you'd probably be torn maybe between, B and C here, which I think was sort of how we went, but that's B. The money comes in as financing. When you buy the equipment, then it's investing. Okay, good. Let's come over and let's start to take a look now at revenue recognition is a little bit misnomer here, and that revenue has a very specific definition and not-for-profit. Okay, revenue comes from an exchange transaction in which the not-for-profit earns the resources in exchange for service provided. For example, as you're probably painfully aware, student tuition at a university, patient service revenue at a hospital. These are true revenues, okay? Contributions are non-exchange. Contribution is when somebody does what? Gives us money out of the kindness of their heart, and there is no obligation for them to donate. It is non-reciprocal. It is non-exchange. I mean, I don't know how many different ways they would say that, okay? Now, what happens? Sometimes in CPA exam questions, you see the word contribution revenue. That's still a contribution. So even though they put the word revenue behind the word contribution, it's still a contribution. True revenue is where the not-for-profit has done something to earn that money. That is a revenue, for example, tuition at a university. But two different categories, revenue versus contribution, even though sometimes the exam puts the word contribution revenue, they mean contribution, where money is being given in a non-reciprocal manner, a non-exchange. They're not, the pledger doesn't, the contributor, the donor doesn't give me something and then say, well, where's mine? They're doing it because they just like us. Okay, they like our charter. Okay, good. Now, whether or not we should recognize a contribution. So we've spent some time understanding whether or not it should be considered with or without donor restriction. What we're looking at now is, should we even report it on the statement of activities? And we won't report on the statement of activities until we've met this criteria. It's not a classification question of where, it's a question of when should we report this on our statement of activities, okay? So if it's a cash contribution, then we should report that when it is received, okay? In the period in which it is received, okay? When it is received, you get the cash, take the contribution. Now, what happens if they don't give us, you can go ahead and flashcard that. What happens if they don't give us the money up front? They promise to give us the money. Well, if it's an unconditional promise, in other words, I promise, don't require you to do anything. I'm going to give you $10,000 next year. Okay, well, that is an unconditional promise to give. And what an unconditional promise to give is a contribution recorded at its fair value when the promise is made. Now that's unconditional. Okay, and you come over to the next page, and if it's a conditional promise to give, now that means that I won't be able to take that contribution. I won't recognize that until the conditions are substantially met. Okay, so let's say I tell you, hey, I promise you, I'm going to give you $10,000 next year. I promise. Okay. And when I give you the money, I want you to use it for the Fluffy program. Well, what happens? We have an unconditional promise. You can take that contribution and it'll go into the with donor restriction column because I told you I want you to use it for the Fluffy program, right? Conversely, I could say, look, I'll give you 10,000 after you've shown me that you can find homes for dogs. I'm going to say that you have to find a home for 10 dogs. If you find a home for 10 dogs, I'll give you 10,000. And then you can use it however you see fit in the not-for-profit, because now I believe in what you're doing. So what happens? Well, since it's a conditional promise, can you take that contribution after you find a home for 1 dog? No. 2? No. 3? Can you take 40%, 50% because it's at 50? No. You take the contribution, you're going to show that on your statement of activities when you found the home for how many dogs? 10. Okay. Now, since I didn't put a restriction on that, when you've met that that condition, now you can put that as what? Contribution without donor restriction. Okay, so don't confuse the two terms. With and without donor restriction says how you can use the money. Okay, a conditional promise means will I even give you the money to begin with? Okay. Okay, good. So go ahead and flashcard that rule as well. Okay. Question on that? Okay. Okay, good. Now come over, and if we have multi-year pledges need to be recorded at present value. Okay. And then the amount we actually collect will be an additional contribution revenue, not interest income. Okay. So flashcard that, but let's just do an example. Let's say I tell you, I'm going to give you $500 next year. And you say, okay, John, you're giving me $500 next year. So I got to figure out the present value of that $500. So you do some calculation and you figure out the present value of that $500 is $475. So you go ahead, you debit pledge receivable, not revenue, receivable. Pledge receivable for $475. You credit contribution $475. Okay, so you've gone ahead and you set up that contribution, you set up that receivable, and that's in year 1. Then I finally give you the full 500 in year 2. In year 2, you go ahead and you debit cash 500. You credit the PR is going to be pledge receivable here, guys, for 475, right? Because you're getting paid now. And that additional 25, the whole point of this example is what? Is considered contribution, not interest. That says contribution gets credited for what? 25. That's contribution, not interest. Okay? Okay, that's all we're talking about there. Now you come over and take a look at this discussion now coming down. Allowance for uncollectible pledges. Okay? And when we're dealing with uncollectible pledges, okay, just write down here, reduce contribution by uncollectible amount. Now this is a little bit weird because what? In commercial, we don't do that. We debit the bad debt expense, right? In not-for-profit, we'll debit the pledges receivable, and I'm just making this number up, say 5,000, we'll debit that gross, And then we go ahead and we set up the allowance. Okay, and I'm just going to pretend that 500 we determine is not collectible, and then contribution, we're going to show 4,500. So we reduce the contribution. You don't do that in commercial. Commercial, you book your sales, your revenue, gross, and then you take a bad debt expense for the part that you think you're not going to collect. In not-for-profit, we go ahead and we reduce the contribution by the amount we think we're not going to collect. Okay. All right. Now, I want to look at something here in e-learning under Chapter 8, and I've called that Chapter 8 slides. See how creative I am? Okay. And I want to open that. Okay. And we're going to go back to the book and look at this notion of split interest agreements here in a second. Okay. But I just like this presentation a little bit better right here. Split interest agreements. Can you see that on the screen okay, guys?
Yes.
Yeah. Okay. Okay. So split interest agreements are basically where the donor gives some money to the not-for-profit, but wants you to share that with some other beneficiary. Okay. And a good example that we're going to consider is a charitable remainder trust. Okay. And so let's just take a look at how this works. Charitable remainder trust. And you can see, I know it's a little hard to see on the screen, but there, maybe make it a little bigger. Agreements such as charitable remainder trust represent donor contributions structured to simultaneously donate assets to the not-for-profit organization and share those with a beneficiary. Split interest agreements are displayed separately on the not-for-profit organization's financial statement, measured at fair value or present value at acquisition, and they are, and we say temporarily restricted here. That's an older term, but I still like this write-up of this. That's basically what, with donor restriction. Okay, so it's going to be shown as restricted with donor restriction. And so you can see, with donor restriction, we go ahead and we put the asset. We show a liability that is due to whoever we're supposed to be sharing this contribution with. And then the portion that's going to come to this not-for-profit is going to be listed there as a contribution. And notice they put the word revenue after contribution. So it is a true contribution. Okay. Now, when you look at this question, and again, this is a little hard to see on the screen, so you might have to move your face very close to your computer to see this. We have this on December 30th. Albert Altruistic donated $200,000 to the Carbon Museum under the terms and conditions of a charitable remainder trust that guarantees Mr. Altruistic a lifetime tax-free annuity of $20,000 per year and bequeaths the remainder to Carbon for use in their operations in the furtherance of the mission of the museum. Apparently, this guy doesn't like his kids. He's got some money. He's just going to give it to the museum and says, hey, just take care of me for the rest of my life and we're good. Okay. So what happens? Independent actuaries have estimated that the museum's liability has a present value of $84,250. I mean, they're looking and saying, hey, this guy's going to kick off in a few years, and you're going to, on a present value basis, have to pay him out $84,250. So what should they report on their financial statement? Now, before you look at the answer here, just look at this journal entry that I wrote in. We would go ahead and do what? debit cash, obviously. We set up a liability for our liability on a present value basis to Mr. Altruistic because we're going to have to pay out $20,000 a year. He's getting a little older, so we figure, okay, he's going to last long enough that we'll have to pay on a present value basis $84,250, and then we will credit. And again, temporary restricted means with donor restriction. Okay, and we consider that with donor restriction because we have to wait for this nice guy to die before we can get the money. So that's a time restriction. So we consider that with donor restriction for the rest. So the answer to this question is increase in what? In with donor restriction for the difference between the present value of the liability and what was contributed. Okay. Okay, now I'm going to show you this in the book as well, but it's also here. Assets and liabilities recognized under split interest agreement should be disclosed separately from other assets and liabilities in the statement of financial position. In other words, on our balance sheet, that cash is going to have to show cash held under split interest agreement. That liability of 84,000, whatever it was, has to be shown as a liability of 84,250. The amount that we took as contribution with donor restriction, that is going to be shown separately on our statement of activities. We'll have to show contribution under split interest agreement. The split interest agreement is what is measured at fair value and estimated at present value, like we saw in that example. Okay, so we're seeing those same things in the text without a good example. So that's why I wanted to go ahead and just show you that slide that I think gave you that pretty decent example, classic example of split interest agreements. Now trying to get back to full screen is going to be what? Examples here are charitable remainder trust. That's what we saw. And we measure split interest agreement at what? At fair value, are estimated based on present value. We saw that. Where's the comment about how they're displayed? Assets and liabilities recognized under split interest agreements are disclosed separately, and contributions associated with split interest agreements are shown separately on the statement of activity. Same stuff you saw on those slides with the example. Okay. Okay, good. Any question on that? All right, let's talk about donated services. Donated services are going to be recognized some of the time, okay? Now, they are recognized if they create or enhance a non-financial asset. Flashcard that. So let's say we need some doggy kennels for our, back to our Save the Canines, and somebody is building those doggy kennels and they say, you know what? I love what you're doing. You're helping animals. I love animals. No charge to put up the doggy kennels. What would we do? We would debit building or, you know, doggy kennels, whatever, but an asset. And we would credit contribution for whatever the charge for that was supposed to be. It was going to invoice me $5,000. I debit building $5,000, doggy kennels $5,000. I credit contribution. I debit the asset. I credit the contribution. Now, if it is a service, okay, if it's a service, in order for us to recognize the value of that service, that service, it has to meet the following requirements. So for a service, okay, I don't know why I had to write service, there it is. Go ahead and use this passkey, SOME. That's a 3-issue, even though there's 4 letters, it's what? It is specialized skill. It is otherwise needed, and it is measured easily. That's the 3rd of the criteria, even though we've given you 2 letters to remember the mnemonic. Services are recognized some of the time. So let's say we're bringing in a veterinarian, and the veterinarian usually charges us $100 a month. And then in July 1st says no more charges for the rest of the year. I went to school because I want to help animals. You're helping animals. We said, thank you. So what do? We're going to sit there, and it's a specialized skill, veterinary medicine, highly specialized, otherwise needed. We were buying it for the first 6 months of the year, and what measured easily for the back half of the year, simply debit service expense, professional expense, veterinary expense, and credit contribution. Okay. Okay, good. Come over and let's take a look at donated collection items. So now people give me things like, I don't know, they give me uh, the original painting of the dogs playing poker. Okay, and this thing has tremendous value, right? And they give it to me, and I decide, you know what? I'm going to hang it up in the lobby of Save the Canine. So what happens? Well, if that's the case, okay, then I do not even have to recognize that contribution on the financial statements, but I have to meet all of the following. So the item is part of a collection, the collection is cared for, and the not-for-profit's policy is that if it were to sell one of those items, it has to use those proceeds to acquire other collection historical works of art. And if you meet all of those requirements, then you don't even have to record those historical treasures, whatever. And this is probably directed more at like not-for-profit museums and stuff, because you can imagine, they may have, what if you're a museum, you're the Louvre, and you've got the Mona Lisa? Well, if you have to put that in your financial reports, no one's going to give you another dime. You got a 10 trillion on a priceless piece of art. So they don't even make them put that on the financial statements, but they have to meet all of these policies, all of these requirements. Okay. Okay, good. Let's take a look at donated materials. Okay, so if somebody gives us a donated material and it's of a significant amount, then I'm going to debit asset, credit contribution. Okay, if they give me donated material that merely passes through the organization, I don't have to record that unless it's substantial. If it's substantial, okay, then they say, okay, well, you're going to have to record an expense and a contribution for that. So that's really in the judgment of the not-for-profit. Sometimes I'll get students that will say, well, I work for Salvation Army, and or what are we supposed to do? Well, I would think a big organization like that is probably going to want to have better record keeping. So they would probably do something like this. Whereas a small not-for-profit that's just receiving a few things that then they're going to be donating to folks that need some clothes or something, then maybe they don't even have to account for that. Okay. Okay, good. So just flashcard that. If significant, do this. If not significant, you don't have to record it. But if it's something that just passes through and it's significant, you would make this entry. Gifts in kind. This is when people give us stuff. So now, instead of giving us money, they give us tickets to the ball game. In fact, maybe we go and we solicit this kind of contribution. We say, look, we're going to have a silent auction, and we're going to put all this junk, all this stuff out on the table, and we're going to have people come and everyone's going to write down their bid. And someone really wants the tickets to the ball game, and they're trying to help the not-for-profit, and maybe they're getting a little tipsy at this thing, and so maybe they'll bid this stuff up really high, right? Well, these are called gifts in kind. Okay, and if you have a gift in kind, sorry guys, I gotta catch myself up here for a second. If you have a gift in kind that is donated as part of a fundraising appeal, they are valued at fair value when received and revalued upon their sale as part of the fundraising appeal. The difference between the fair value at the time of donation and fair value at the time of sale is accounted for as an additional contribution. So what happens? Somebody gives me tickets to the ball game, whatever, right? So what do? Let's say they give me 2 tickets, they're worth $100 each. I debit tickets, I credit contribution. for 200. Now they go ahead and they start doing the silent auction and people are having a good time and they bid those tickets up to $300. Well, now what am I going to do? Well, of course, when they give me the money, I'm going to debit cash 300. I'll credit the tickets for 2, and the point of that flashcard up there is the additional amount that comes in is an additional contribution, okay, for the additional amount that came in on the tickets there, okay? Okay, good. Now you come over and let's just take a look at we don't need all these journal entries, guys. They don't get the exam doesn't get all hopped up in asking you the journal entries to do the reclassification adjustment. They just want to see, do you know that when you do the reclassification adjustment, that amounts come out of the without donor restriction and come out of the with donor restriction and go into the without donor restriction. I don't know why they came up with such difficult to articulate wording, okay? But that's how that works. You don't need to worry about the journal entries, okay? Okay, good. Now you come over and let's take a look at fundraising, okay? And when a not-for-profit offers premiums, etc., okay, that is considered fundraising expense. So, you know, you get a doggy calendar. Well, we have to, you know, when you donate 10,000, we'll send you a doggy calendar. So what happens? Well, now we've got to take pictures of the dogs and print the calendars and all that. All that activity would be considered fundraising expense. Okay. Also, the difference between contribution made between the contribution made by the donor and fair value of any premium transferred is classified as contribution revenue, and you can kind of see that down there. I was involved in a not-for-profit one time where we got somebody on our board of directors just because we thought maybe they would be able to get some money out of their organization that they could contribute to us. So we asked him on the board of directors, and he couldn't be a board member unless he paid his dues. So I kind of told him, well, look, Joe, you got to pay your dues, blah, blah. And he reaches in his, you know, suit pocket, whatever, and he says, will this cover my dues? And it was a contribution from, it was Bank of America for $5,000, and the dues was only $50. Okay, so okay, we've got what? We've got dues being paid of 50, but we've got a contribution of 4,950 in that example. So he knew why we were asking him on the board of directors, was one step ahead of us. Okay. Okay. Now we're going to talk a little bit about specific not-for-profit industry revenue recognition here. Okay. And when we look at revenues for educational institution, classic example is student tuition and fees. Okay. Government grants, contracts. These are examples of revenues earned by the educational institution. Now, I don't know why the CPA exam likes to ask about this, but you know, you would take off the amount of tuition for canceled classes, and then you would report that as gross revenue from tuition and fees. So kind of think of that canceled classes as what? Sales returns. You have your sales minus returns. If they don't run the class, you're going to return that money, and then you'll have the revenue from tuition and fees after backing out canceled classes. I don't know why the CPA exam thinks that's so interesting, but if they do, you've got a flashcard on that. Okay. Now you come over and let's talk about hospitals, healthcare organizations. Okay. And we have patient service revenue. And patient service revenue include things that you do to patients, surgery, yikes, right? Okay, recovery room, all that stuff, medical services, doctors. These are examples of patient service revenue. Now, notice they tell us that patient service revenue should be accounted for on an accrual basis at established standard rates even if the full amount is not to be collected. Even though we record the patient service revenue, deductions are made from gross revenue to recognize patient service revenue net of deductions. Now, what are they talking about here? Well, look, a hospital may charge somebody, I don't know, $20,000 to fix a broken arm, okay? But they're not going to charge Medicare $20,000 for that because Medicare says, hey, you got to give us a better price for that service. They're not going to charge Blue Cross $20,000 for that because Blue Cross says, hell no, we're going to bring you a lot of business. So in order for you to be able to take Blue Cross at this hospital, we want that arm fixed for $10,000, okay? Because Blue Cross is the one that's going to have to pay. So even though they would originally record that service at $20,000, they say deductions are made. And here we go with deductions, and the deduction would be contractual adjustment for third-party payments. Okay, so there would be a deduction in that example. I forget what I said now. They want to charge you $20,000 for an arm, and Blue Cross says, hey, $15,000. You'd subtract $5,000 from that, right? Okay. Charity care. Okay, what happens? Somebody's injured and they're rushed into the hospital. I don't care if they don't have coverage. Hospital got to take care of them. Okay, so if they have some sort of charity care like that, it is not recognized as a receivable or a revenue. It is not a bad debt expense. Okay, so flashcard up there, they kind of separated this out a little bit, that deductions are made, and the classic example of the deduction is the deduction for contractual adjustment for third-party payments. Okay, all right, now be careful. When we talk about, and you can see gross patient revenue, and then we subtract the charity care. Okay, now I want you to be careful of something. Oh, I'll get to that in a second. Just coming down, other operating revenue. Okay, just think of the hospital, but now you're not getting cut on. Of course, if the cafeteria is really bad, maybe that could be considered to being cut on. Okay, but flashcard, the nature of other operating revenue, it's things that the hospital does that's not directly related to patients, right? Okay, and then non-operating revenue, the third category, okay, just flashcard these, okay? So in investment income, donated services, okay? Sometimes maybe a practitioner will donate their time. Happens, a nurse or something donates their time, then we would go ahead and we would treat that as non-operating, okay? Okay, good. Now you come over and they give us the three categories, okay, that I had you flashcard the details under those, but just remember three categories: patient service revenue, I told you to flashcard things of that nature, other operating like the parking lot and stuff, and then non-operating, and notice again, it includes the donated services. So that's a good pass key too, but I want you to have the detail. Okay. All right, good. Let's take a look at, well, hang on a minute, guys, because there was that thing I wanted to warn you about, but I didn't see it. Okay, 1 second, because it's kind of an important point, but I don't know. Okay, I'll tell you what, let's do the question together, and I'll explain it to you here. Okay, so let's do question 2 and 4 together. because they've decided to hide it from me now and I can't find what I wanted. Let's do 2 and 4 together though. Okay, and this is the be careful moment. Okay, so what happens? We've already said that if we're going to receive a contribution and we determine some amount of that contribution is not collectible, we should do what? Reduce the contribution. Okay, so here PICA received $10,000. PICA, government or not-for-profit, received an unconditional promise of $100,000 expected to be collected in 1 year. Okay, PICA anticipates collecting 90% of the contribution. What amount should we put as contribution revenue? And again, if the word revenue comes after the word contribution, it's a true contribution. So what they're going to do is go ahead and debit the pledges receivable for the full 100,000, credit the allowance for what? It's 10%, 90, they're only gonna get 90%, and credit the contribution for the balance, which is the 90,000. Okay, so the answer to this question is C, 90,000. I think you remember we talked about that, right? Well, that's a contribution. If it is a service, then we don't reduce the service revenue by the amount of the uncollectible. We take a bad debt expense, and we do that now because what? Because now it is an exchange transaction. We're getting paid for a service, so we don't sit there and reduce the contribution or the revenue. Essentially, we do what? We take a bad debt expense. So now when you look at this question down here, notice the difference. Okay, and that's why I tied these two questions together. So we got this hospital with no governmental affiliation, report the following accounts and gross patient revenue, and they tell us that it's 775,000, and they say, hey, this includes charity care, and they want the net patient service revenue. So I'm going to take that 775. What am I going to do with that charity care number, since it includes charity care? Am I supposed to include charity care in there?
Deduct. You have to deduct it.
Good. So I'm going to go ahead and I'm going to subtract that 25,000. Good. Okay. Now, let's deal with the second one, the third one here. Difference between established billing rates and fees negotiated with third-party payer contractual adjustments. So what am I supposed to do with that? Remember we said deductions are made for third-party contractual adjustments? Okay. So I've dealt with those two. And then they tell me provision for bad debts. Now, since I'm billing patients for a service, I don't reduce my patient service revenue. I set up a bad debt expense for the amounts that I'm not going to collect. So I'm not going to deduct that. I'm just going to leave that out of the equation here. And so when I go ahead and do the math on that, I have to get what, 680,000? Okay, so that's an important distinction between those two. If it's a contribution, then reduce the contribution by the amount you think you're not going to collect. If it's a service revenue, then you don't reduce the revenue. You would have taken the bad debt expense and set up the allowance. Question? Okay, good. Let's go ahead then. Now you can go ahead and look at questions 3 and whatever the ones we didn't work. Let's see, 1, can start with 1 and then go to the others. Well, we'll do them one at a time anyway. Okay, 5 seconds. All right, let's go ahead and let's take a look at this one, okay? And most of you got it right. The choice is D, okay? But let's take a little closer look. And first off, let's deal with the fact that I can't find my pen. Let's deal with the contributed legal services. Should we recognize the value of that service?
Yes.
We should. Okay, so when you look at that, you know coming in that what? B is wrong because B is ignoring that 100,000, right? Okay. Then they say, well, a promise to contribute 500,000 in year 8 from a supporter who has made similar contributions in prior periods. Is there any condition attached to that? No. So there's no way that what? Well, I guess we could still get to the rest of these. So we're kind of stuck with A, B, and C now. Okay, I thought we could get rid of another one, but no, we can't. Okay, the question is that 500,000 restricted? And the answer is yes, it is restricted because we can't use the money yet because we don't have it. So whenever there's a pledge that's going to go out over a second year, it is automatically considered with donor restriction as to time because you're not going to get that money until the future. Okay, so we know then from that the 500,000 is going to be restricted. We know now that it is what? It's B or D, and it can't be B because they ignored what? They ignored the 100,000. We know we have to include it, so you could get to D that way. And the 875, even though they said it can be used as the board's discretion, that by definition means that it is unrestricted without donor restriction. Okay. Okay, good. Let's take a look at number 3. Okay, guys, let's go ahead and wrap this one up. I'm not giving you as much time. I think this one's pretty straightforward. The returns are coming in pretty much 100% on the right answer. Okay, so B is the right answer, and they have these theater tickets, and you give 150, and you get a theater ticket that has a fair value of 100, and they put your name in the program. You know, the name of the program, we don't put any value on that. And so since you done 150 and you get a ticket that had a fair value of 100, that's a contribution of $50. Okay, good. We already saw this question. So let's look at question 5 here. Okay, let's go ahead and take a look at this one now. And most of us got it right. Here, the choice is D. And you always have to kind of be careful of these choices that say a memorandum entry only. And I'm kind of like, what does that mean? Okay, but let's just take a look. On April 1st, year 1, Delta Hospital purchased medicines from Field Pharmaceutical Company at a cost of $5,000. However, Field notified Delta that the invoice was being canceled and that the medicines were being donated. Delta should record the donation of medicines, and it's going to be what? As other operating revenue when you have a donation of that sort. It's not credit to expenses. That's nonsense. Okay. Okay, good. Now, what I want to do at this point is go back to the slides that I showed you before. And the slides that I showed you before are basically what I'm going to use to explain the balance now of chapter 8, because I just feel that the way they organize some of the things is a little bit hard to follow. And I just organized it, same material, just a little bit differently, assuming I can find my slides in the slides. Okay, so let's just come up and let's take a look at contributions involving an intermediary. So what happens? So I don't know if you've ever dealt with like a fundraising campaign at work or something, and they have it organized by, say, United Way or something. And in there, you can check off little boxes that say, hey, I want my contribution to go to Save the Canines, whatever. Okay. Well, if you organize your contribution that way, you have not granted United Way variance power. And so when United Way collects that money from you, okay, they're going to have a liability because you've directed them how to use that money. You have not granted them variance power. Now, some people, when they give money to a not-for-profit intermediary like United Way, they sit there and they say, hey, you guys decide who to give the money to. If that's the case, then what? Then United Way will be able to record a contribution. Now, the ultimate beneficiary, if you give United Way variance power, the ultimate beneficiary will record a contribution. If you give United Way variance power, you tell them they can use the money, then they take the contribution, and ultimate beneficiaries of United Way do nothing. Okay. All right. So that's where we're going. And you can see what's in red here. As a general rule, the intermediary recognizes an asset, usually cash, and a liability to the beneficiary, which is the credit, when it receives a contribution from the donor for the beneficiary. This is a no variance power situation. Okay. In this instance, the beneficiary recognizes the contribution as support revenue, contribution revenue. Okay. Now, just going over to the next slide. Okay. An exception occurs if the intermediary has variance power, which allows it to redirect the asset to another beneficiary. So if you tell United Way, you just decide how to use the money, you've granted them variance power. And at that point, the recipient, the ultimate beneficiary, won't do anything. Okay. Now, if the intermediary is a financially related with the benefit organization, such as a fundraising foundation, you give the money to the foundation, and then the foundation is required to give that money to, say, the university. If that occurs, either of those two bullets occur, then the intermediary will account for that as a contribution. Okay. Now, just let's look at this example. Okay. And they tell us that principles are largely driven by the application of the concept variance power. Okay. So what FASB considers the common situation of a foundation, the recipient, which raises money for another not-for-profit organization, the beneficiary. Now, if this happens without variance power, then the recipient will debit, usually cash, and credit the refundable advance, the liability. Now I tell you, see item B of the next page. And when you go over to item B of the next page, and you just come down to item B, now we're dealing with the recipients and the beneficiary, what they do when the grant was given to the recipient without variance power. The ultimate beneficiary here does what? Debits the receivable and credits the contribution. Okay. Now, if the money is given and it's given what? Given now with variance power, now the recipient, I put recipient up there in that box, now the recipient has the power to decide who they're going to redirect that money to. If that's the case, then what? Then they'll go ahead, debit the asset, usually cash, credit the contribution. And if you follow that weak attempt at an arrow down for the what? For the beneficiary in a with variance power situation where the money was given to the recipient with variance power, they do nothing because they don't know if they're going to get that money or not. Okay. So you take a look at this example, and again, these are pretty hard to read. I realize that, so I'll try to make them as big as I can on the screen. The city of Lawrence United Way received a donation of a vehicle from a concerned citizen on January 1st, and they stipulated that the vehicle was to be donated to the Lawrence Daycare Center, a not-for-profit organization, but went on to stipulate that Lawrence United Way could use the vehicle for a period of 1 year prior to the transfer. The vehicle had a fair value of $9,000 and remaining useful life of 3 years. The Lawrence Daycare is a United Way organization, but does not have the ability to influence United Way policy. United Way elects to use the vehicle. Okay, so they're going to use the vehicle for 1 year. On their December 31st, 20X1 financial statements, each organization should display the following. And notice that what, and I tried to write these journal entries underneath the appropriate organizations. So for United Way, they got the vehicle, so they debited the asset vehicle. They credit contribution for the 3,000 for the part that they are giving granted variance power because they could use the vehicle for a year, and then they take a liability for the remainder because they're going to have to give that over to the daycare center. The daycare center does what? Sets up a receivable and a contribution for the $6,000. That's the remaining 2 years that they'll plan to get. And again, unrestricted is without donor restrictions. Boy, now I'm having trouble keeping track of my pen. Okay, so unrestricted means without donor restriction. And what? Temporarily and permanently restricted mean what? With. Okay, but the key takeaway here is what? They go ahead and they take a contribution unrestricted for the 3,000 for the what? For the daycare center, they're going to go ahead and put their portion, okay, because they didn't have variance power for the last 2 years on that. United Way didn't. And so that, of course, is with donor restriction. Okay. Okay, good. Investments. Investments treat securities as though they are trading securities. That's all you need to remember. When a not-for-profit gets a security, it treats the security as what? As a trading security. All unrealized holding gains and losses go straight to the statement of activities, and you mark it to market each period. Okay, that's it. There is no held to maturity. There is no available for sale. It's all treated as a trading security. Okay. Okay, good. So that means it's reported at fair value, and unrealized holding gains and losses are reported on the statement of activity, reported on the income statement. Okay, and I think we looked at this already, right? Okay, that wraps up the back end of that chapter. Yeah, that's annoying because it's another one of those no time left to start chapter 9 things, because by the time I start it, the class is over. So any questions? So Thursday, we will just have to see where we land in terms of finishing as much as we can at chapter 9. And then I may just have to record the lecture and post it up for you for, you know, whatever we don't get to in chapter 9 and chapter 10. We're just going to have to handle it that way, because I can't, you know, require you to come to class at a certain time, but I can sit here and record those and post them up for you is the best we're going to be able to do, because I don't anticipate that we'll be able to get successfully through both chapter 9 and 10 next time. Okay. Question, guys? All right. If there are no questions, I'm going to go ahead and call it an evening. I see no reason to sit here and try to squeeze 12 minutes out of the situation. And I will see you on Thursday. Okay.
Thanks.
Yeah.
All right. Good night, guys.